How do rising interest rates affect your investments? First, let's talk about equity or stocks. Rising interest rates affect the value of stocks in your portfolio in three ways. First, when interest rates rise, fresh money that is coming into the stock market instead gets diverted into fixed deposits and bonds because the interest rates on those products have moved higher. When the amount of money coming into the stock market reduces, the market tends to fall and therefore your stocks tend to fall. The second way in which rising interest rates affect your stocks is by changing something called the discount rate. So how is a stock valued? A stock is the present value of all the future earnings of a company. Now, in order to arrive at this present value, those future earnings have to be converted to present money using something called the discount rate. And when that discount rate rises, which is in fact the interest rate, the value of those earnings fall and therefore the value of your stocks falls. The third way in which your stocks get affected when interest rates rise is simply by the companies which have borrowed money, which have taken on debt, having to pay out more money in interest payments. This leaves less money to shareholders as profits. Now, what happens to the value of your debt funds? Unfortunately, this also tends to fall as interest rates rise. And why is that? Because the value of bonds, which is what debt funds hold, that value tends to fall, and that value falls because the cash flows of a bond are also discounted by the discount rate, which is the interest rate. So when that interest rate rises, the cash flow value falls and therefore the value of the bond falls and therefore the value of your debt fund falls. The final thing we can look at is what happens to fixed deposits when interest rates rise. And here there is some good news. When the RBI raises interest rates, banks eventually raise their deposit rates as well, and you get more money on your FDs.